Welcome to the daily update, where I'll go over the action in the market for Monday, September 9th, and then we'll see how things look for Tuesday, September 10th. Had a pretty nice little rebound, but it really didn't change anything. Our indicators have not switched back over to positive. It was an inside day because we didn't get above Friday's high and we didn't go below Friday's low, but it worked off some of this extreme negative conditions in the short term that we've been seeing. And we were seeing a couple in the intermediate term. Those appear to be worked off now. We did see mega caps and semiconductors bounce after they had a really bad week last week, but it really hasn't shifted the overall climate. We're still looking negative overall. So we're going to have CPI on Wednesday. We're going to get PPI on Thursday. Of course, everybody's anticipating what's going to be happening with the Fed. Is it going to be a 1/4% rate cut or 0.5% rate cut? And the debate goes back and forth, and the market dukes it out and tries to put their side of their conclusion in process. Okay, so I have a thing called the SPXInvesting Program. It's free, it's available. There's a link that'll take you to that site in the description below this video. Also, a link to another video that talks about the program. If you want to talk to me about it or have any questions, please feel free to send me an email. And one of the benefits that you get from being a member is you have early access to the daily videos and over the weekend, the weekly videos. Also, the daily video that I do is the real foundation of my analysis and commentary. All of the other videos that I do are meant to feed into the daily video. All right, let's go back and talk about what happened. We had a gap higher open. The futures just worked their way higher, and we ended up having a pretty positive open. I made a post on the website saying, I wonder if this is a trap. And for a little while, it looked like that might be happening because we had the big down week, and especially Friday was down this buy the dip, which I don't buy into. I wait for the charts to confirm what's actually happening. I don't try to front run what's going on. But we did see this move higher, and that led to the open. We declined for a little bit, but then we're able to get that back, and we closed well off of the highs. But because of the gap, it produced a pretty nice up day. So we did have a gap higher open above the daily pivot at 54.45, and then prices initially climbed, but then reversed back below the daily pivot. Then prices got back above the daily pivot and kept climbing, but didn't get all the way up to R1 at 54.86. We declined from there down to 54.50, and then we were able to bounce back up just a little bit to close at about just a little bit above 54.70. So we were up 1.16%, still not up as much as Friday's decline was, but we recaptured that. And volume was still above average. So to see an up day with above average volume, that tends to be positive for the market. And we are still negative in the short and intermediate term. We're positive in the long term. So the bigger picture is still hanging in there, but we've not been able to get back above the 20 or 50 period moving averages. Those are still potentially acting as overhead resistance. And we're going to get the inflation picture at least updated with CPI and PPI coming out later on in the week, and then all the different geopolitical things, just in case they influence what happens in the market. Some comments. It was an inside day, as I explained earlier. Mega caps and semis did outperform where they had been weak. Last week, they saw some buying in Monday's session. Oil is still below $70. And as I also have been pointing out, we're watching this mainly for geopolitical reasons right now. If oil really spikes up, that may be due to an escalation of things in the Middle East, and that could end up being negative for the market. The VIX also dropped back under 20. So we're in that area where we see positive annualized returns after climbing above 20. And then we're still going with this mass index signal that was triggered like 3 weeks ago now. And what triggered that was when we were coming up after the weakness we saw in early August. And this indicator tries to suggest that there will be a reversal. Well, until we actually switch back and look more positive, we're still kind of working off of that signal itself, but we're using the other charts to confirm this. And then we did have an initial Hindenburg omen that was triggered last week, and we haven't seen the confirmation yet, but this is in effect. It has to be 20 trading days, and we have to have that happen by October 3rd. And then on a short-term basis, we just have the CCI 14 and the stochastics that are looking extreme negative. After Friday, we had a much longer list. And in the intermediate term, overbought now with the 10-day moving average of the S&P 500 highs minus the lows. It's coming down, but it's still in that extreme area. But that's suggesting more intermediate to even somewhat long-term momentum that is positive. And then we saw enough of an up move on Monday to put the 200-day simple moving average back above that extreme positive reading, which again could also suggest longer-term positive momentum. The scenario has not changed since the last time I did a video. We're just anticipating, okay, what's the Fed going to do? Or how much are they going to cut rates? And the dollar was up, interest rates were down. We still keep going down with that 10-year yield, not by very much. We closed at 3.7% with the 10-year yield, where after Friday we were at 3.71%. And we're still inverted with the 10 to the 3-month, but we're back to being normal or uninverted with the 10 to the 2. And that's what a lot of the debate going back and forth is, because once this goes back to being regular again, that begins a countdown to see, okay, are we going to go into a recession? Sentiment is still negative because of the update. We ticked up from 39 and we're still not looking real positive there, coming in at 42. We are starting to see a trend though, and that trend is negative for right now. So we're crossing above the moving average. Now, it hasn't been a confirmed trend yet because it's just below 20 with the ADX, but it's getting stronger since it's turning back up and it's getting above its moving average. But we're still below 20, as I said. And with the up day, the bias is positive. I'm still keeping the momentum at negative until we see a little bit more positive action, just more of a rebound than what we saw in Monday's session. Then with the economic reports, kind of lean, and until we get CPI on Wednesday, we're not seeing anything that has that big of an impact on prices. Wholesale inventories came in up 0.2%, less than the 0.3% that they had expected, and the same as the 0.2 that we saw last time. Consumer credit, a lot more. I mean, people are having to use credit these days. It came in with an increase of 25.5 billion. They expected 11.5 billion increase. Last time it was up 5.2 billion. So here's a chart just showing the wholesale inventories. And the reason we look at this is this inventories mean a product has been developed, but it hasn't gone out the door yet. And so if there's a lot of things sitting on the shelves, that could have an impact on the economy. And here's consumer credit on a year-over-year basis where it had been declining, but now it's starting to turn back up. And then the monthly change here really shot up. This is higher than what we've seen now in quite a while, as folks are going through the summer and apparently having to use credit in order to do things. And then Isabel Net blog charts, it says market concentration remains near a record high. And this is just saying, okay, the market cap of the 6 largest S&P 500 companies, it's 29% currently. And we get charts like this, the 10, the Magnificent 7, the 8 stocks, the top 15. You can, but some people find this interesting to look at a chart like this, just to show you how much the really big companies really impact the S&P 500. Here's a technical analysis chart of the 10-year yield. It's a daily chart, and it has a lot of extra lines on here that I usually don't put on charts, but just to give you an idea, they're still anticipating things going down. We did see a death cross here that the moving average is crossing below. So the trend for interest rates is still to go down. And then, of course, they've got these different little lines on here, and we're breaking below. There's possibly some support here. at about the 3.67 level for the 10-year yield. So we're just keeping an eye on that, but I don't do as much analysis on this. We just mainly follow the general direction of interest rates. And then equities struggle around the uninversion if the economy enters a recession. We're looking into the future here. I showed, it might be the same chart that I showed last week, that this is how things go after the recession within 12 months after the uninversion, and then how things end up going after that. So it's there's a lot of speculation about this. And I did an updated video on the website about what's the recession outlook right now. And there's charts that we look at that suggest everything's going to be fine. There's other charts that we look at that give us a concern that we may go into a recession. But those charts can change at any time, either looking less likely like a recession or more likely like a recession. But the problem with some of those charts is there's a real delay. And by the time we wait to actually see it, because they're government-based charts with long-term data, and if you wait until you get confirmation from those charts, it's too late at that point. But we just want to see the general trend of things happening. The second biggest outflow from crypto on record, Bitcoin didn't have a real, or I guess all cryptos kind of suffered last week. And then discretionary, which means you have an investment plan where you can become more defensive, move things around, try to anticipate a switch in the market, versus a systematic positioning type of strategy where you're just pretty much riding out the indexes. And this is just showing that as we were going down in early August, folks saw that and were able to react to that, and that ended up holding up a little bit better than just using the systematic approach of passive investing by getting into maybe S&P 500 ETFs or mutual funds that way. Then small business funding rate, the highest in 22 years, at least. Okay. There's just money going into small businesses, and they like the idea that interest rates have been coming down, and that helps small businesses because they need to borrow an awful lot of money. And the market implied change in Fed funds rate. The takeaway from this is 6 to 12 months out, they are anticipating the Fed funds going down, cutting interest rates. And then what are people putting their money into? And this is the year-to-date sector winner, and tech is number one. And it's such a huge part of the stock market. And a lot of people put their money into that. And then materials and financials, where we're seeing outflows year-to-date in some of these other areas. And this is more on a global scale here. And then this was kind of interesting. I actually found this last week. It's the NBER. And this is the folks, the agency, which is supposed to be independent, but they work with the government. They're the ones who actually decide, okay, we are in a recession now, or no, we're not. And this is when they actually make their announcement. And then we see here, this is prior to 1979, there were no formal recession announcements. There's a lot of information that we get now that used to not happen. Like the Fed meetings, they would just kind of maybe put out a paragraph into, the Wall Street Journal or something. Now it's like everybody really waits in anticipation. But this is when they actually determine the yellow here is, it's like, okay, you can see where there can be a bit of a delay from the time that they actually say, okay, this is what's happening, until the market says, well, we've already known that for quite some time now. All right. And then this is put out by Real Investment Advice. This is, since the 10 to the 2 year, there's still the 10 to the 3 month. It's not gone back to being regular. It's still inverted. But then I say that we have a countdown that begins once the 10 to the 2 goes back to being uninverted. And Lance Roberts puts out here, says, while the inversion of various yield spread equates to economic weakness, the uninversion is historically a recessionary signal. And historically is kind of the key word. It doesn't necessarily mean that's what's going to happen, but it doesn't mean that's not what's going to happen either. We could end up going into a recession, and the graph shows that the recession can take almost a year following an uninversion. I've looked at other statistics that say it's about 5 to 6 months. He's saying here it could be a year off into the future. So we we can watch this unfold and just kind of adapt to it as needed. And then which yield curve or which yield spread actually matters. I chart a number of these, but some of them are important, some of them are not. Personally, the market tends to focus on the 10 to the 2 year, which was what we just talked about, and I have a chart later to show you of that. I also follow the 10 to the 3 month because especially Edward Yardeni, who's an economist that I actually respect, he follows that. And so he bases things around that. And that still has a ways to go to get back to not being inverted any longer. All right, here's our chart. And a lot of the gains that we ended up seeing were from the gap higher. We gapped above the daily pivot. We were starting to go up. Just things kind of fizzled out here. And then it looked like, okay, is this the pump and dump? Well, it looked that way to start with. We didn't even come down and fill the gap, though, before we got back above the daily pivot. And you can see there's not an awful lot of conviction as we're going up here, even though we are going up. We didn't even make it up to R1 before we saw a decline. We came down here and set a little bit of a bounce at 54.50 before closing just a little bit over 54.70. And you can see here the blue or green area here, a lot of the strength was really seen before the market even opened. This is still a concern to us. We have the red line above the blue line, and growth did bounce back up at least later in the day, but it's really underperforming value. And that just means on an intraday basis, it appears as though the market is becoming more defensive, getting ready to decline, possibly. And this is another thing that's been a concern to us since about the 20th, 21st of August. We've been seeing the S&P growth to value ratio really going down, even though it showed a little bit of improvement, but not all that much in Monday's session. So on an end of day basis, growth was up a little bit more than value. It was up a little bit more for the mid caps, and both small cap growth and value were both down, where here small cap growth was actually down less. So we saw a little bit of a tick up here with our small cap growth to value ratio. The mid cap growth to value ratio ticked up just a little bit, but still looking pretty weak and not really showing much of an improvement here with S&P growth to value. This is what I was watching during Monday. Is growth really outperforming value? That would really suggest that maybe we have a chance of switching back and looking more positive. To this point, no. This just looks kind of, I hate to call it a dead cat bounce right now, but we haven't really seen much of a shift back to positive. Now, that could change going forward from here. We just have to evaluate things where they're at right now. And then we didn't really see much of an improvement here when we look at the growth to value ETFs. We're below the rainbow and not really showing much strength currently. And we also ticked up just a little bit with discretionary to staples, but not very much. Large cap growth, it's coming right back up to its 100-day moving average. This could be providing some overhead resistance. And seeing our trend here, we are starting to turn up. We're going above the moving average right now. Now, the red line came down, but it's on top. And so that's why we default to positive or to negative here. And we're seeing the green line actually still continuing to decline. If we cross back above 20 and we're still above the moving average, this would then be a confirmed trend. And if the red line is still on top, that would be a negative trend. And we're seeing that pretty much same thing here in the short term, where it's already crossed above its moving average. We were seeing that after Friday, but we're still below 20 here with even the short-term ADX. We are picking up, and we were above average with volume. And then sentiment, this is a weekly gauge that we look at where it's 78.73. That's much different than the charts we've been looking at, where we're more negative with the sentiment we follow. And then every week we get the insider transaction ratio. When it gets up into a higher area here, that ends up being more bearish for things. Well, it dropped back down, but it's still a little bit above this black line, slightly bearish for stocks. And we want to keep an eye on the spread between risky and not as risky bonds. It's more prevalent when we look at this next chart, the middle area. This is an inverted version of what we just saw in the previous chart. With this going down, that means the risk is going up, and that could cause some concern. We are seeing a pickup with the ulcer index as fear is continuing to increase, but we did tick down and drop below 20 with the VIX. here with the line chart as well as the bar chart. And when the VIX goes down, the VIX of the VIX also goes down, both with the bar chart and the line chart. But the momentum of the VIX still continues to be up. And here's the historical chart of the VIX as well going forward. Now we're up into this red area, and we saw enough of a decline here with the skew index, which is a variation of the VIX that uses out of the money options to be calculated. We dropped down slightly below this red area now. So the big move that the market had been expecting, well, according to this chart, maybe that's done for right now. But we could always turn and go back up into this red area. And we declined a little bit here with this fear gauge, and we also declined a little bit with this other fear gauge. So we saw fear going away a little bit in Monday's session. And we're ticking back up just barely here, but the risk on to risk off ratio still continues to go down overall as the market has been becoming more defensive. And a little bit of a tick up here when we look at large caps versus small caps. Small caps were actually down pretty much the whole session. They were negative while the rest of the market was looking a lot more positive and ended up closing down on the day. And we did decline with the equity put call ratio daily chart, but we're still going up with the 5-day and the 10-day chart. This is more negative. This is more defensive for the market. And we're coming up into the higher end of the band here with the volatility risk premium. Could suggest a little more defensiveness going on. And we're turning back up and still doing okay here with the advanced decline line based on price and volume. We're still above an advancing moving average here. And we did see more new highs than new lows in Monday's session, but we're still going down with the 5-day and the 10-day. But for right now, this seems to be holding up, this internal measure that we look at. And we ticked back up, and we're still looking okay with the advanced decline ratio, both with the 19 and the 39 period. And we were able to cross, we almost got down to zero here based on price with the advanced decline ratio. We did cross back above zero here based on volume. And this is the 10-day average of the highs and lows for the S&P, coming down, but still in this extreme positive area. But the Chaikin money flow, this is a smart money indicator. It still continues to fall. The Chaikin oscillator ticked up a little bit, but is still negative. And the vortex is continuing to be negative. And accumulation distribution, we're still below the moving average, even though we turned up slightly. So this is still negative itself. And when we look at the S&P and compare it with the NYSE advanced decline line, we're still hanging in there pretty good. The broader market is still doing better for right now. We look at the S&P 500 advanced decline line on a cumulative basis based on price, where we tick back up. We also tick back up a little bit more with the bar here, the line, based on volume. And we're starting to come down, though, when we look at the 50-period moving average of new highs minus the new lows. That's longer term. And here is just a daily score of the new highs minus the new lows. We're still positive there. And then this is that same chart, just shown in a different way here that we just saw on the previous page. The cumulative NYSE advanced decline line based on price did go up, and we're hanging in there okay with the regular advanced decline line for the NYSE. And this other NYSE advanced decline line is still doing okay for right now. And we look at common stock, just barely ticked up based on price, a little bit more of a tick up here based on volume. And then we look at a broad market measure of the 5-period moving average of the highs minus the lows, coming down, but still above zero. So we're looking okay here with the NYSE common stock advanced decline line. We turned back up with the S&P, bounced off the moving average with the mid caps, but we're looking more negative here with the small caps and dropping below the moving average. So we're still below the 50-day moving average here for the S&P. And then on the bottom, we're just barely above the moving average. And we might have overdone it in Monday's session with the 1-day rate of change going from Friday to Monday. We could still go up from here. But when we get above this blue area, that means that maybe the market overdid it a little bit. It's not suggesting a reversal. It just potentially could mean an exhaustion of price. And we tick back up with the 20, 50, and 200 period moving averages on the S&P 500. But the condition of our short-term trend still is showing a deterioration. The lines are going down, and we're below both lines. And we're below both the simple and exponential moving averages based on 20 periods. We're no longer extreme here with the boom indicator. After Friday, we had got kind of far away from that 20-period moving average. We bounced up just enough. And this is one of those extreme negative readings that wore off in Monday's session. And we're coming back up slightly, but we're still looking more negative with the 50. And we're ticking back up a little bit here with the 200. And we're no longer extreme negative with the Stochk RSI or the Williams percent R. The CCI 14 is still extreme, even though it ticked up, but the CCI 20 never did get extreme negative. And with the short-term stochastic, we're no longer extreme. We bounced up there. Where we're extreme is still in the intermediate term, but we're still negative when we look at the longer-term stochastic. And the force index, which came all the way down to the Keltner band here, it bounced back up. It's negative, but it's worn off that extreme negative reading. We're not extreme here. We're in the -1 standard deviations channel. And we, after dropping below 50 with the stocks in the S&P above their 20-day moving average, we now were able to cross back above 50. And we ticked back up with the 50-period moving average study, the 100 and the 200. So a little bit of an improvement there. The balance of power is still below zero and declining. That's negative. We're still below both lines with the condition of our 50-period moving average, and the lines are also rolling over. And the longer we stay below these lines, the more negative it will be. And we're below both the simple and exponential 50-period moving averages. And we could suggest that the exponential 50-period moving average is acting as overhead resistance. That was pretty much the top that we hit. But the market tends to focus more on simple moving averages. And we are keeping an eye on the 100-period moving averages in case we decline. Will this end up providing some kind of support? And so all of the moving averages here, still below the 20s and the 50s and still above the 100s. We came down to this anchored moving average, going back to the low set in last spring. And maybe that is acting as some kind of support. We were able to bounce off of that, but we came right up to this low set in early summer, or I guess it was later May or so. And that could be also acting as overhead resistance. We're still negative with the go, no-go chart. And we're still dancing around the red line, which is the lowest low value here. And we're below the midpoint with our highest high, lowest low value chart. The TTM squeeze continues to decline, and it's the darker shade of blue. And standard deviation, we're still going above the moving average here. That means we were showing some real speed with the price of the S&P 500. We're still negative with the ease of movement. We're below zero. The Erin indicator is still flat and still positive. And after coming almost down here and looking extreme negative, the S&P McClellan oscillator did bounce back up, but it's still negative. So when we look at the summation index, we're still declining based on price and volume. We bounce back up with the NYSE McClellan oscillator, but we're still negative here. So we're declining with the summation index for the NYSE based on price and volume. We're negative with the Swenlin trading oscillator. Even with the big up day on Monday, this didn't change. And momentum is now switching over to negative. We're negative with the PMO. When we break it out based on price and volume, we're also negative. And after being extreme negative with the PMOs that are rising, we bounced up just enough to wear that off. But the buy signals are declining and still slightly declining with the PMOs above zero. We're still negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're declining and negative here in the short term with the slope oscillator. The MACD continues to be negative. So in the short intermediate term, we are negative, and we're starting to cross over negative with the TRIX and KST, which are our longer term oscillators. The Copic curve continues to be negative. The Sean trend meter is still more neutral now. And this is kind of interesting too. I was pointing this out as a positive thing after Friday when we saw the big decline, and this barely went down. Well, is it a little bit of a concern that we had a solid up day on Monday and this still continued to decline? Now, this is still positive overall because we've been going up and we're still above 50, but we want to keep an eye on this because this is a different kind of indicator that measures the point and figure buy or sell signals. And if this really starts to fall apart, that means there are things happening inside of the S&P 500 that are weaker. The NYSE bullish percent index also, it didn't go up. It actually went down here, but we're still positive. And we ticked up just barely, but we're negative with the NASDAQ 100 bullish percent index. We ticked up, but still negative with the ultimate oscillator, ticked up, but still negative with the money flow. We're still below the moving average here when we look at the on-balance volume, even though it ticked up. And we're still below 50 with the RSI 14 and 9. And this is that mass index now. It's continuing to drop off here. Once we finally get beyond what we're dealing with right now, and then I'll drop this chart from the videos. And this is somewhat positive now. We were on the weekly chart of the S&P. We were able to get back above this R2 level after losing that on Friday. If we can stay above this, that would be more positive. If we drop down below this pivot point level, that will be more negative longer term. And we're still into the cloud here. We actually dropped a little bit below it after Friday with the Ichimoku cloud. We came back up here, and the blue line is still above the red line. So this is positive. And the green line, which is really hard to see, it had been declining, but now it's starting to turn back up. We're still negative, though, when we look at the Heikin Ashi chart. The Kagi chart is negative since it's red, but now it's pointing up. We're still negative with the Renko chart and the three-line break chart. Long term, we're not extreme now with the 150, but we ticked up just enough to get above this red line with the 200-day simple moving average, looking extreme positive for right now. But again, that could also suggest good longer-term momentum. So we're still negative in the short term with the Keller market model. We're negative also in the intermediate term with the NASDAQ 100. We're negative in the short term with stocks, positive across the board with bonds, and negative across the board with commodities and the dollar. And saw some blue or green here. We did see discretionary have a bearish MACD crossover, and this is a concern. It had been showing some improvement, but this is a technical signal that is negative, and this is one of the areas that we want to see do better if we're more positive on the market. But we had real estate hitting a 2-year high. It's more defensive, and they like that interest rates are going down. Canada had a pretty good day here, and then the rest of these are just as the NASDAQ is trying to bounce back up. And all of the sectors ended up being positive, with tech being higher after just getting hammered last week. Discretionary had a fairly good day as well. And communication, which is another area we want to see doing better, it was up, but up the weakest as far as the sectors. And we look at the equal weight versus the S&P, where we're still holding up. Actually, the equal weight seems to be doing a little bit better these days than the S&P 500. And that just suggests that there's more stocks that have been participating to the upside. And we ticked up just a little bit here with the S&P slightly outperforming the equal weight in Monday's session. But overall, this has been declining as the rest of the S&Ps has been, on an equal weight basis, has been doing better. This is still a little bit of a concern here, where we're just coming off of a recent all-time high with the S&P equal weight, but we're declining even though we ticked up. We're just coming back to these previous highs when we look at the QQQ equal weight ETF. And we were up over 1% here above the 50-day moving average with the Dow. We've gone from being negative to neutral with the diamonds for the based on the Elder's Impulse system. And really no change here with the NASDAQ. It was up over 1%, but still below this pivot point, still below its 50-day moving average. That's the negative part, but we're still above the 200-day moving average here. And pretty much the same thing with the NASDAQ 100. Below the pivot point, below the 50-day moving average, but still above the 200. We're still negative with the Elder's Impulse system for the Qs. We're still negative with the momentum for the NASDAQ 100, and we're still below the 20 and 50 period moving averages here with the Qs. Small caps ended up being down. They dropped below their 50-day moving average. And we ticked back up just a little bit here with the Russell 2000 small caps when we look at the RSI, but we're still below the 50-day moving average, and the momentum is still negative. We're still negative with the Elder's Impulse system for the small caps. And we ticked up just a little bit here. I'm sorry, we ticked down here with the small cap to tech ratio, because tech had a pretty good day and small caps were down. But overall, we've been seeing this ratio continuing to go up for the most part. We're still below the 50-day moving average with the mid caps, and we're still negative with the Elder's Impulse system for the mid caps. The Wilshire is still below its 50-day moving average. And we're still below the 50-day moving average here with the total U.S. stock ETF. Financial sector bounced back up. It's one of the stronger sectors right now, even though it got hit last week with everything else. It's still above its 50-day moving average. And the financials are still looking pretty strong when we do a ratio to the S&P 500. The FANG index is still below its 50, still above its 200, and it bounced up 1.42%. We haven't been able to get back above this longer term trend line yet, even though we bounced back up in Monday's session. The staples to tech ratio, it fell just a little bit, but it's really been going up here as staples, which are defensive, have been outperforming tech, which is growth, and this would be more negative. And we're also getting ready to potentially see a golden cross here with this ratio, meaning on a trending basis, staples could be starting to outperform tech, and that's more defensive for the market. Amazon still was able to get back above its 200-day moving average. We're still about at the moving average with Apple. We're still below the moving average with the 200-day moving average with Google, and slightly below the 200-day moving average with Microsoft, at the 50-day moving average with Meta, and in between the moving averages with Nvidia. Just got hammered last week, and so it was up 3.5% on Monday. Tesla is right in between its 50 and 200-day moving average and was up 2.63%. Netflix is still above its 50-day moving average and was up 1.45%. And we're seeing this shorter term correlation between US stocks and the rest of the world stocks starting to get a little bit stronger, even though we're trailing off slightly with our longer term correlation. Oil is still under 70. Again, we're watching that mainly for geopolitical reasons. The dollar is still in a downtrend, even though it was up in Monday's session, and we're coming back above this downward sloping trend line with the dollar index. We're keeping an eye on utilities. This could very likely be a defensive measure that's going on here. They were up over 1%. Another defensive area are staples, and that's still looking pretty solid. And healthcare, also another defensive area because you have to have healthcare no matter what's going on with the economy. That's still looking pretty good there. We did decline with the 10-year yield, or we were up with the 10-year with price. This is a ratio here between the tech sector and 3 to 7-year bonds. We're still below the moving or the longer term rainbow here, and this is a moving average based on 250 periods. We bounced back up, but we need to see more strength than what we're seeing right now. We look at the QQQs, the 3 to 7-year bonds, coming right down to the 250 period moving average, and it was able to bounce up off of that. Is that going to mean something? We found some support here back in early August. We were able to bounce up off of that. So far, it looks like the market is trying to see if that can happen again. We're just going to watch this to see if that can continue or if it will fail. This is the 10 to the 2-year yield, where now we have 2 trading days where we've closed above the zero line here, suggesting that we're uninverted now. And we're not really seeing much of a change here with growth to value. The Qs to S&P still declining, still looking okay with discretionary to S&P, but declining when we compare large cap growth to large cap value. Not what you want to see on a rebound day. You want to see a more of a shift here. And so we look at the small cap, or the large caps, mid caps, and small caps. A little bit of a bounce with the small caps, but all are still below their moving averages. And the S&P to utilities ratio still continues to decline. That's negative for the S&P, and the staples to S&P continues to go up. Well, it ticked down just a little bit, but overall, you can see where this line's going up, and that's more negative for the S&P. And then we do have a non-confirmed Hindenburg omen right now. This just goes through what the different criteria that you need here. But I just look at the chart. We had this generated back last Thursday. We have until October 3rd to see another spike here. So what's our outlook for Tuesday? We're now negative and we're still below support. We really didn't change all that much. You know, here we are up over 1%, but the charts really are still looking negative to this point. And we're going to get the NFIB small business optimism. That's all that's coming out on Tuesday. And then all the geopolitical things in case they have an impact. The big day is going to be CPI on Wednesday, PPI on Thursday. We're going to get consumer sentiment on Friday. So I don't have anything marked here because really the only major thing is going to be in Wednesday's session. That's when it'll start. Seasonality, though, we tend to look pretty good for September 10th. We're positive across the board with the Dow, S&P, and NASDAQ. And we do see a little bit of positive seasonality here, possibly a little bit more of a bump up along the way with this chart, but we're pretty much you could flip a coin, whether we're positive or negative based on what happened in 2023. But we are a little more positive so far to this point in 2024. And we're still at the beginning part of September. You see a little bit of weakness coming in here as we get into the 9th, 10th, and 11th or so. But it's really the later part of the month where things become much more negative for September. And just trying to compare 2024 to 2023 to see if we're going to end up playing things out in a similar fashion there. So the warning signs, when we look at our smart money indicators, we're still looking negative. The accumulation distribution still below its moving average. Chaikin money flow is declining, and the Chaikin oscillator, even though it ticked up, is still negative since it's below zero. We're watching the staples, utilities, and healthcare, and we're kind of just keeping an eye on energy as well, because these tend to be more defensive areas. The equity put call ratio based on 5 and 10 periods, they're both going up. And the S&P and NYSE McClellan oscillators, as well as summation indexes, are going down. Parabolic SAR is negative. Our oscillators, we haven't quite crossed over in the long term, but the short and intermediate term oscillators are negative now. The money flow, the ease of movement, the Swenlin trading oscillator, they're all negative, and the momentum and bullish percent index for the NASDAQ 100 is negative. The ultimate oscillator is negative, the copy curve is negative, and the vortex is negative as well. And we're really concerned about this growth of value. We want to see growth doing better, and it's just not right now. We want to see discretionary doing better than staples, and it's just not right now. Then on the positive side, we have our advanced decline lines. They are showing some weakness now, even though they ticked back up in Monday's session. But the small caps are the weakest part. They're the only index right now that are below the moving average for the advanced decline line. The bullish percent indexes for the S&P 500 and the NYSE, they are declining, but they didn't really go up in Monday's session, but they're still positive overall. And the financial sector is still looking pretty solid there. So our conclusion, we are still negative and we're below short and intermediate term support. We're wondering, is that going to provide some kind of overhead resistance? In the short term, we're negative and below the 20-period moving average. In the intermediate term, we're negative and below the 50-period moving average. But we're still positive in the long term with the 200-day moving average looking a little extreme right now. Thank you. I hope you found this helpful. I really hope you have a good day, and I will talk to you in the next video.